Hi, I'm gonna start with the business activity of Astro Malaysia Holdings Berhad. So let me give you a quick overview of Astro. This is one of the Malaysia's top media companies and was founded in 2003. It's grown into a leading entertainment group. Astro runs a pay TV called Astro and free TV called Enjoy, and even a streaming service named Suka for online viewers. They also own a Astro Radio, which reach more than 16 million listeners every week. In total, they serve around 5.3 million homes, or about 65% of Bermaz Auto Berhad is a key automotive company in Malaysia that has been around since 2010. They are best known for handling the distribution and after-sales service for brands like Mazda, Peugeot, and Kia here in Malaysia. They also take care of Mazda distribution in the Philippines, which show their reach beyond Malaysia. The company got listed on the Bursa Malaysia in 2013, and recently they have taken a bold step into the EV market by becoming the official distributor for Xpeng electric vehicle, along with the other three
major brands. The current ratio assesses Astro Berhad's ability to meet its short-term obligation using its current asset. The formula is current asset divided by current liability, which Astro Berhad recorded 1.46 billion in current asset and 1.25 billion in current liabilities. This results in a current ratio of 1.16 to 1, meaning that for every RM1 of short-term debt, the company has RM1.16 in current asset. This indicates a reasonably healthy liquidity position, showing that Astro Berhad is capable of settling its short-term liabilities with its available current asset. Is the quick ratio, which provides a more conservative view of liquidity by focusing only on most liquid assets such as cash, deposit, and receivables, and excluding inventory. Using the formula quick asset divided by current liability, Astro Berhad's quick asset, which includes cash and bank balance, deposits, and receivables, when divided by the same current liabilities, the quick ratio is 0.54 to 1. This means Astro Berhad has only 54 cents in highly liquid asset for every RM1 of short-term liabilities, suggesting that the company may need to rely on inventory or other assets to fully meet its short-term obligations. While the current ratio reflects overall adequacy, the quick ratio signals a tighter liquidity position and the need for careful cash flow management in Astro Berhad. We move to Astro Berhad's activity ratio, which helps assess how efficiently the company uses its asset to generate revenue. Well, there are two key ratios there. They are total asset turnover and total accounts receivable turnover. First, the total asset turnover ratio measures how effectively the company utilizes its total asset to generate sales. The formula is net sales divided by average total asset, where Astro Berhad recorded net sales of 3.34 billion and the average total asset calculated from the beginning and ending balances, which is 5.68 billion. Well, this gives a total asset turnover of 0.59 times, meaning that for every RM1 of asset, Astro Berhad generates 0.59 cents in sales. This indicates a moderate efficiency in using its asset to produce revenue. Next, the account receivable turnover ratio evaluates how efficiently the company collects payments from its customer. The formula is net sales divided by average trade receivables, where Astro Berhad's net sales remain 3.34 billion and the average trade receivable amount to 517 million. This results in an account receivable turnover of 6 times, meaning the company collects its receivable approximately 6 times a year. This indicates a good collections efficiency, showing that Astro Berhad is relatively efficient in managing its credit and receivable. So let's take a look at Astro Berhad's profitability ratios, which help assess the company's ability to generate profit from its revenue and shareholders' equity. Alright, so there will be two ratios that I will cover, which are, the first one is profit margin on sales and the return on common shareholders' equity. Alright, when we talk about the profit margin on sales, it measures how much of the company's revenue remain as net profit after all expenses are deducted. The formula is net income divided by net sales multiplied by 100, which Astro Berhad reported a net income of 67,000 million and net sales of 3.34 million. Using the formula, the profit margins works out to 2.03%. This means that for every RM1 in sales, the company earns about 2 cents in net profit. While the company is profitable, the margin is relatively low, indicating that operating costs or other expenses take up a large portion of its revenue. Alright, so the next one will be the return on common shareholders' equity, where it shows how effectively the company generates profit from the equity invested by its shareholder. Where the formula will be start with net income minus preference dividends divided by average common shareholders equity multiplied by 100. Since Astro Berhad has no preferred dividends, the full net income of 67 billion is used. In average equity based on the remaining and ending balance is 1.12 billion. This gives a return of 6.04%, meaning that the company generated 6 ringgit 4 cent in profit for every 100 of equity invested by common shareholders. This reflects a moderate return, showing that Astro Berhad is generally steady, though it's not high value for its shareholders. After the last part, which is Astro Berhad's leverage ratio, which is measure the company's financial risk and how much it relies on debt to finance its asset and operations. Well, there are two key ratios. Here are the debt to asset ratio and the debt to equity ratio. So the first one, the debt of asset ratio is calculated by dividing total liabilities by total asset. Well, for Astro Berhad, total liability amount to 4.5 billion and total asset are 5.66 billion, resulting in a ratio of 0.8. So this means that 80% of the company asset are financed through debt, which indicates a high level of financial leverage. A high ratio like this suggests a greater risk as the company has a significant amount of obligations. So the last one would be the debt equity ratio, where it measures the proportion of debt relative to shareholders' equity. It is calculated by dividing total debt by total shareholders' equity, where Astro Berhad has total debt of 3.25 billion and shareholders' equity of 1.15 billion, giving a debt to equity ratio of 2.83. This means that for every 1 ringgit of equity, the company has 2 ringgit and 82 cents in debt. This further highlights the company's heavy dependence on borrowed funds, which may increase financial risk, especially if interest rates rise or cash flows become strained.
Financial ratio analysis on Bermaz. The first ratio is the liquidity ratios, which is the current ratio. The current ratios measures a company's ability to pay short-term obligation using its current assets. The calculation for the current ratio is current assets divided by the current liabilities. For Bermaz, the current ratio is 2.16, which means that every 1 ringgit of Bermaz current liabilities can be covered by RM 2.16 of the current assets, which shows that Bermaz has a good sign of good short-term financial health, where it improves more of the assets more than the liabilities. Next is quick ratio. Quick ratio is a stricter measurement of liquidity. It excludes inventory from current asset and is calculated by quick assets divided by current liabilities. In the term of Bermaz, the quick ratio of Bermaz is 0.48, which means that every 1 ringgit of Bermaz current liabilities can only be paid as much as 0.48 ringgit of the current assets, excluding the inventory, which means that Bermaz may not handle its short-term obligation without relying on selling inventory, because the company that have more than one can only say that they can handle the short-term obligation without relying on their selling inventory. The second ratio is the activity ratios, which is first is total asset turnover. This ratio shows how efficiently a company uses its assets to generate sales. It's calculated as net sales divided by average total sales. For Bermaz, the total asset turnover is 2.13 times, which means that this shows that every 1 ringgit invested in assets can generate sales of 2.13 times, which means that Bermaz has using its asset effectively, because a higher ratio means that the company using its asset effectively to generate revenue. Next is account receivable turnover, These ratios measures how efficiently a company collects its revenue from its customers. It's calculated as net sales divided by average trade receivables. In the term of Bermaz, the account receivable turnover is 18 times, which means that Bermaz collects its average account receivables approximately 18 times per year. This shows that Bermaz is able to collect its receivables quickly, which improve cash flow. This ratio helps assess the Bermaz credit policies and how well it manages the customer's account. The third ratio is the profitability ratios. The first is profit margins on sales. This ratio shows how much a profit a company can make for each ringgit of sales. It's calculated as net income divided by net sales. In the terms of Bermaz, the profit on margin sales is 9.61%, which means a profit margin of 9.61% means that the company earns 9.1 ringgit in profit for every 1 ringgit in sales. This indicates that the company's ability to generate profits from its revenue. This is also means that the company, which is Bermaz, able to retain more from each sales after covering all the expenses. Next is return on common shareholders' equity. Return on common shareholders' equity measures the return generated on the equity of common shareholders. It is calculated as net income minus preferred dividends and divided by the average common shareholders' equity. In the term of Bermaz, the return on common shareholders' equity is 42.96%, which means that a return of 42.96% means that the company makes 42.96 ringgit in earning for every 1 ringgit invested by common shareholders. This is a good indicator of profitability for shareholders. This is also mean that Bermaz is making more efficient at generating profits for the shareholder investment. The fourth ratio is the leverage ratios. The first is debt to asset ratios. This ratio shows the proportion of a company's asset that are financed through debt. It is calculated as total liabilities divided by total assets. A higher ratio means that more of a company's assets are funded by liabilities rather than equity, which can increase financial risks. However, some level of debt is normal and the ideal ratios varies by industries. This ratio helps assess long-term solvency and financial stability. In the terms of Bermaz, the debt to assets ratio is 0.52, which means that a ratio of 52% means half of the company's assets are financed through debt. This level of leverage considered as moderate risk. Next is debt to equity ratios. These ratios compare a company's total debts to its shareholders' equity. It's calculated as total debts divided by total shareholders' equity. A higher debts to equity ratios indicates more reliance on borrowed funds, which may increase risk, especially if interest rate rises. However, it can also enhance returns when used wisely. This ratio is closely watched by investors and lenders. It gives insight into a company's financial leverage and capital structure. In terms of Bermaz, the debt to equity ratio is 0.43, which means that a ratio of 43% means that the company has RM0.43 in debt for every 1 ringgit of equity. This shows that the financial structure is balanced.
Now, I will presenting a financial comparison between Bermaz Auto Berhad and Astro Malaysia Holding Berhad. Firstly, for liquidity ratio, a current ratio of Bermaz Auto Berhad shows stronger liquidity, while for Astro is a quite healthy in ensuring a firm efficiently using its asset. Both companies show that they can cover the short-term debt and making good use of its assets. Hence, it is clearly that Bermaz have a better current ratio as the total current ratio is higher than Astro. A quick ratio of Astro show a stronger liquidity position, while a quick ratio for Bermaz is show a weaker liquidity position. Astro have 50 cent ringgit in quick asset for every 1 ringgit of current liability. However, the quick ratio for both companies is still below 1 ringgit, which indicate that both companies need to rely on inventory sale to settle short-term liability. However, the company have better quick ratio is Astro compared to Bermaz. Next, activity ratio. Total asset turnover ratio for Bermaz more higher compared to Astro. The higher ratio means that the company is generating a higher volume of sales with the given amount of asset compared with its competitor. That means Bermaz has a better performance in the producing sales or revenue by utilizing its assets compared to Astro. Account receivable turnover show for Bermaz more higher turnover ratio, whereas Astro has a lower turnover. That means Bermaz Auto Berhad is doing better than Astro National Holding Berhad at issuing credit and converting it to cash, as well as collecting its account receivable in specific time periods. It indicates that Bermaz Auto Berhad is more efficient in handling its collection. Profitability ratio Bermaz show a higher profit margin on sales percentage compared to Astro. In a comparison to Astro, Bermaz Auto Berhad is more successful at turning sales into profit. Bermaz has a higher return on equity compared to Astro, indicating that Bermaz is more efficient in utilizing shareholder equity to generate profit. This suggests that Bermaz management is better at converting equity into earnings, which could mean stronger financial performance and a potentially more attractive return for investors. On the other hand, Astro lower ROE reflect less efficiency in using its equity to generate profit, pointing to possible challenge in the profitability or less effective use of capital. Leverage ratio. Astro Malaysia Holding Berhad has a higher debt to asset ratio compared to Bermaz Auto Berhad, has a lower debt to asset ratio. This difference reflects that Bermaz Auto Berhad have a better cost control and lower financial risks compared to Astro. Bermaz has lower debt to equity ratio, reflecting a more conservative approach to financing. This indicates less reliance on debt and lower potential financial risk, compared to Astro with a higher debt to equity ratio has a higher level of leverage, which means it relies more on debt to finance its operation. This could mean higher risk, but also the potential for better return if the borrowed funds are managed effectively.
My name is SYAFIQAH and my metric number is 307679. Today I'm going to talk about improvement suggestion. For Astro, the financial analysis of the Astro highlight low performance in their financial ratio. A lot of parts require improvement to maximize overall efficiency and growth. By addressing these weaknesses, the company can enhance its financial position and achieve more sustainable success. First, liquidity management. Astro current ratio of 1.16 indicates possible problems in meeting the short-term obligation. In order to improve this, Astro must work on enhancing cash flows by efficiently collecting revenues, eliminate wasteful expense, and reducing short-term liabilities. In addition, the company also can convert some short-term debt into long-term ones and invest cash in higher return opportunities. This will help Astro improve liquidity and better prepare for short-term financial needs. Secondly, account receivable collection. The account receivable turnover ratio of 6 times indicates that the company collects cash from customers relatively slowly. This will negatively affect cash flows and increase the possibility of bad debts. The company should adopt more effective credit policies, such as reducing the credit period for such customers who pay slowly and providing some incentive for early payment. This way, it will speed up the cash inflows, hence improving working capital efficiency. This in turn will help company use cash more efficiently to fund its growth and operations. Next, leverage management. Astro debt to asset ratio of 80% and the debt to equity ratio of 2.83% indicates the company's high reliance on debt. Although this will help the company grow, it will also raise financial risk. For improvement, Astro needs to focus on debt reduction by utilizing its excess flow to repay loans. It may also refinance existing debts to get lower interest rate or longer tenures for repayments. Lastly, it could raise funds through equity or partnerships to reduce dependence on debt. Lastly, profitability and returns. The profitability ratio shows a profit of 2.03% gain from revenues. However, the return on shareholder equity of 6.04% indicates that there is a high returns for shareholder while the profit are lower. For suggestion, Astro can start forming partnerships with popular brands to further enhance its reach. On the cost management front, the company should optimize operational expense by renegotiating supplier contracts and adopting automation tools to improve efficiency. Next, improvement suggestion for Bermaz Auto Berhad. The financial analysis of Bermaz Auto Berhad highlights strong performance in activity and profitability, but certain parts require improvement to maximize overall efficiency and growth. By addressing this weakness, the company can enhance its financial position and achieve more sustainable success. First, improve quick ratio. Bermaz quick ratio has 0.48, which is below the ideal benchmark of 1.0. This suggests that the company may be overly reliant on inventory to meet its short-term obligations. To improve this, Bermaz should consider optimizing its inventory management to reduce excess stock levels and increase liquidity. In addition, the company could focus on increasing more liquid current assets such as cash and account receivable. A review of short-term liabilities and financing terms may help reduce pressure on the company cash position. Next, receivable management. Bermaz has a high account receivable turnover of 18 times, which means the company collect money from customers quickly. This is a good sign, but it's also important to make sure it does not cause problems for customers or hurt business relationships. Bermaz should keep a balance between collecting payments fast and giving customers enough time to pay. The company also use a better system to track which customers have paid and which one have not. Giving discounts to customers who pay early could help improve cash flows without putting too much pressure on them. Leverage monitoring. Bermaz has low level of debt compared to its assets and equity, which means the company is not taking big financial risks. This is good for safety, but it might also mean the company is not fully using its chances to grow. If Bermaz takes on a bit more debt in a careful and smartful way, it can use the money to grow the business and earn more profit. Also, using some debt can help reduce taxes because interest payment can be tax deductible. However, Bermaz should always manage the risk well to make sure its finance stays strong in the long term. Last but not least, profitability and returns. With a profit margin on sales of 9.61%, Bermaz return on equity of 42.96% is higher than expected. To further enhance profitability, Bermaz should focus on expanding its property portfolio and improving their operational efficiency. The company can also use low-cost debt to fund growth opportunities that can boost their revenue.